FFF. Oh God. I want to thank you guys for joining us tonight. And I want to introduce you to a wonderful guest that I have here with us tonight. Anthony LeBlanc, and he goes by senior. It was not on his advertisement, but I want to let you know he is a senior. He is also an independent financial advisor. He is a FVP with First Financial Security, and he has a wealth of knowledge that he will be sharing with us tonight. So we have a lot in store for tonight and a lot of great information. So I really want you to make sure you take notes. We will have time for some questions towards the end. So without further ado, I would like to invite Anthony LeBlanc Sr. The floor is yours. Thank you, Anthony.
Good evening, ladies and gentlemen. It's a pleasure to actually be here. I've known Jean for quite some time now, and I believe this is she's asked before, but I wasn't. So this is my first time actually being graced with your presence, and I'm excited about the information that we have to share with you this evening. I've been in this industry since 1985, which is a long time. It just hearing that in my own head. I've also been in the real estate and mortgage industry as well since 1989. So I've gravitated to things financial. Previously to my financial career, I was a longtime employee with Federal Express in the transportation industry. And I was just sharing something with Jean a few minutes ago where I was the benefits coordinator because I felt so strongly about preparing for retirement back in those days until I found out certain things through research, which I'm going to share with you tonight. So, Jean, do I have the ability to share?
Yes, you do.
All right. Let me know if you guys can see the screen.
I can see it. Can you guys see that?
We can see it.
Very good.
Okay. So Jean asked me to talk a little bit about annuities this evening, as well as if we have time to get into the IUL, which I'll talk about that as well. And so that's where we're going to start. Anyone here listening, and this is kind of interactive, do you currently know about annuities or have annuities or have heard something about annuities? Anybody here tonight? Yay or nay?
Yes.
Okay, great.
Yes.
Great. I'm glad to hear you guys speak up because I forgot to say this too. I'm also the board chairman of the Cerritos Chamber, and that's why I've been so busy over the last year. Next week is my official end to that term, and a beautiful young lady, great friend, is going to be taking over as the board chair, and I'll be a civilian again, but still with the chamber and doing some great things. But when we do some of the meetings, it's hard to get people to interact a lot of times, and so it was just great hearing some interaction there. So I'm going to go ahead and start annuities for retirement, and that's what our initial presentation is on. Okay, so there's 5 reasons, in my opinion, to get an annuity. There may be more, there may be less, some may be more important than others, but there are 5 reasons that I think are very, very important as to why you should get an annuity. Number 1, it can create
Here's my background right here.
guaranteed predictable income for you. Okay, guaranteed and predictable income. Would you agree that's something pretty good?
Yes.
Okay, all right. Number 2, you can decide when to turn on that income. So you may be entering into pre-retirement, or you may not be there. You get to decide when you want to turn on the income, or you may already have a pension or Social Security that's kind of doing its thing until inflation kind of takes things up to the next level and you need to turn that income on. You don't have to turn it on right away. You have control over that. Okay. Number 3, you can customize the annuity to your own goals and flexibility. Like I said, you have flexibility with this, with annuities. And I'm going to talk about the different types in a minute, but that flexibility is important. You know, a lot of times with other investment vehicles, there's a lot of rules and regulations and stipulations and things as to, you know, how you can take the money, when you can take the money. It's just a lot. An annuity is, in my opinion, one of the investment vehicles that goes unnoticed. Number 4, you have the ability to protect against loss. Let me say that again. That's probably the most important. You have the ability to protect against loss, which means you don't have to lose money. You know, there's other vehicles where, and I've been involved in these vehicles, savings vehicles, where you put money in only to find out later that something happened and you lost your money. Maybe not all of it, maybe a quarter of it, maybe a half of it. But if I'm working hard for money and I'm putting it away diligently to save for my retirement, I don't want to lose any of it. And I don't want to hear that I have time because I'm young enough to, well, back in the old days, not anymore. I'm young enough to recoup. That's not what I wanted to hear. In fact, I'm going to tell you a story down the road here. Number 5, creating income for life. That's another real key component with annuities. You know, you don't want to, number 1, do the wrong thing for retirement and then find out during retirement you did the wrong thing. And now you're 65, 70. And as long as we're living today, find out that you ran out of money. And now you got to find out how to get money for the next 15, 20, 30 years. Some people are living into their hundreds. I have in my family, long life from my mother's side and my father's side. So the longevity means that I have a pretty good chance of living to maybe 100. So I got to be thinking about that. And you have to think about that too. When you think about your families, your mom, your dad, your grandparents, you got to kind of think about, well, how long did they live? And because science is always getting better and improving, it's a good chance you're going to probably outlive them. So you definitely don't want to outlive your money. You know, about the early 80s is when Ronald Reagan kind of changed the game with this. And the reason it changed is because prior to that, and you probably heard stories, a lot of you look younger than I am, so I know I heard the stories. My grandfather, he worked for Dodger Stadium for a number of years, and he was able to retire with that gold watch and that pension. Well, back then, 85% of Americans were on a plan where they received a pension. 15% were not. Take a guess what that number is now. How many people do you think, or what percentage of people do you think receive a pension versus not? Anybody? Take a wild guess. Unmute yourself. Looks like Terry wants to say something. Unmute yourself, Terry, or give us.
I would say 30%.
30%. Good
Have a
guess.
pension.
Good guess. Anybody else?
10%.
You're really close. The actual number is, it flipped. 15% of the individuals today have a pension and 85% don't. And that's why people have started to put money away in their 401ks. I work with a lot of teachers. I work with a lot of law enforcement. They have the 403B, the 457. Individuals are putting money into their Roth IRA, their IRA, because they have to self-fund their pension nowadays. They don't have the luxury of having a company. In fact, most people don't stay with companies like they used to back in the day. You know, it's always a constant change. And especially with what happened a couple of years ago, now people don't even want to go to a company. Everybody wants to work from home, which I like that. Okay. So how do you get an annuity? Number one, look at current and future needs according to your goals. Okay. And then you look at your current ability, because some people might already be doing something. Some people may not be doing something for their future. But you have to look at your current ability, and then you have to take future funds into account. You have to figure out if you have the ability or availability to invest for your future needs. There are so many different ways nowadays, though, that we could add to what we're doing. We don't have to, back in the old days, you had to, if you wanted to get more money, you had to go out and get a part-time job, which required you to maybe go somewhere, clock in, deal with traffic and all those type of things. Now you could create a side income for yourself through the internet, or maybe driving for Uber or something like that. So if you truly have a goal and are serious about it, if it requires you to have a couple of extra $100 to put away or $300 extra to put away, there's ways to do that nowadays. Determine objectives for income, growth, or both. Some people are looking for more income. Some people are looking for growth. Some people are looking for a combination of both, which we're going to talk about in the presentation. Okay. And then you got to select the providers based on what they offer. As far as myself and my company, we're what is considered an IMO, an independent marketing organization. Some people call it an FMO, a field marketing organization, which means instead of working for one company and having just the products of that single company, we have the ability to work with multiple companies to basically give the best options to our clients. If I'm working for one company that only has certain options and I'm talking to a client and I don't have that option available or the best option available for them, in order for myself to make money, I have to sell that client something from the portfolio. I don't like that. So what I did is I made sure that I have a number of carriers. Most of them have at least 100 years plus experience in the business. One of our flagship companies has almost 200 years of experience in the business where they've never missed paying a claim. And so that is very important to me. Fourth, you complete an application and supply the funds to your annuity to get started. Okay. Fifth, there's also a free look period. Some people, they may get cold feet, or they may not do something because they don't want to be committed or anything like that. We give you a 30-day free look period where you can kind of test the waters, make sure that you're comfortable with your objectives, make sure that the provider is the right provider for you, and make sure that we're going to satisfy your goals, etc. Okay. Now, what is an annuity? Because this is where I struggled in the beginning. I didn't even know what an annuity was. I heard about the 401k. And I knew a little bit about it. I heard about an annuity, but I didn't really know what an annuity was. An annuity is a long-term investment issued by insurance companies designed to protect customers from the risk of outliving their income through what is called annuitization. Okay, that's pretty cool. A long-term investment that protects the customer from the risk of outliving their money. I like that. Okay. Number two, the funds contributed to an annuity are converted to periodic payments that could last throughout your life. And the reason I say that could last, because it has to properly be set up for it to last throughout your life. You can't, and I'm going to show you some numbers in a minute. You can't put some numbers together and think that, let's say you got 100,000 and you're spending $50,000 a year. It's not going to last your entire life. So you got to be practical. Okay. The purpose of getting an annuity is not only to create an income stream, but it also transfers the risk of that income stream over to the insurance company. Similar to homeowner or fire insurance with the homeowner, where you're transferring the risk of a fire happening in your home over to the insurance company. Okay. And so I just want you guys to kind of absorb this and get this. We're going to get into the nitty gritty here pretty soon. And this is the final page on what an annuity is. As far as types of annuities, there really are a wide selection of annuities out there to choose from in this world today. But there's really basically two categories when it comes down to it. Okay. And those two categories are an immediate annuity or a deferred annuity. And that's what we're going to talk about, the differences. Okay. So let's look at an immediate fixed annuity. It's basically in the name. The income feature is turned on immediately, right away, which is typically used for someone going into retirement like yesterday. They're going into retirement right now. And the fixed feature means that the income portion will always be the same amount, whether monthly or annually. Again, the IFA or immediate fixed annuity is turned on immediately for fixed income, monthly or annually for the lifetime of the retirement or retiree. Okay. So you guys are getting kind of a training today. So you'll know more than the average person out there after today. Okay. We also have the deferred fixed annuity. And again, it's in the name. There's no gotchas. There's no magic here. The income is deferred and will be turned on at a later point in time, somewhere in the future. This is typically used when someone is planning for retirement down the road, maybe even years and years and years down the road. And the fixed feature is the same as the previous page. It's a fixed amount that will be paid every month for the lifetime of the retiree. Okay, again, DFA is turned on down the road, and a fixed amount will be paid monthly or annually, lifetime, for lifetime income for that retiree. Now, here's the point where I wanted to kind of give you some numbers, payout example. So this actually is a old screen. They used to tell us, when it comes to a lump sum in an account, you want to average that person's payout from anywhere from 3 to 5%. That's when people were living much shorter lives. Okay, people are living longer now. So if you want to stretch the money out longer, you can't pay as much on a monthly basis. It has to be a little bit less in order for a person to have that money coming in for their entire life. So I just highlighted age 65. That, I know people retire early, 62. In fact, I'll be 62 this year, and I'm already getting all that kind of stuff bombarding my email in my snail mail. But 65 is average. Some people wait until 67 or later. At 65, if you had $100,000 sitting in an account, that could pay you $561 per month. So what I did is I said, well, wait a minute, how many months is that? So basically you take 100,000, divide by $561, it's going to give you a number. I can't remember what the number is. I think it was 200 or something like that, in that range. And then you divide that by 12 months, and it's going to give you how many years it'll take for that money to run out. I think it was close to about 14 or 15 years that the money is going to run out. So if you're planning to live to age 79 or just shy of 80, then, maybe that's a good goal to shoot for. But most of us, again, are living well into our 80s, 90s, even 100s. And so here's the example here that I just kind of tried to do in my head when I should have just pressed the button. 100,000 divided by 25 years. If you're going to live to age 90, you're 65. 100,000 divided by 25 is 4,000 a year, or $333 a month, instead of the $561 a month. Okay. Now, if you want more, then you have to reverse engineer that for your retirement. Let's say you need $3,000 a month. You don't have a pension, you're not getting Social Security, or you're getting very little from Social Security, and you figured out your gap is about $3,000 a month in your needs for age 65 when you retire to about 90. So we take that 3,000, multiply it by 12, that's 36,000 a year. We multiply that 36,000 a year by 25 years. That gives us $900,000 that has to be put away in order to have that. Now, I'm not taking into account inflation, any interest building on that account or anything like that. This is just the simple numbers without any of that. But those other things are also definitely going to affect it. Okay. Again, at the very beginning, I talked about some other examples, for late bloomers. I've talked to many individuals that have not started in their 20s or 30s or 40s, maybe starting in their 50s, and sometimes, believe it or not, in their 60s, putting money together for retirement. It takes about a good 20 years to put together a decent retirement. Okay. And so if you don't have that, then you have to look at other options, maybe a side hustle or something like that will bring in, or people are doing wonders today where it comes to the internet. They're making lots and lots of money on the internet. I haven't figured that out yet, but hopefully one day I will, and maybe I can teach on that as well. But these are some of the things that you can do. And one other thing I spoke to Gene about is, because I'm in the real estate and mortgage industry as well, if you're a homeowner and you haven't done what it takes to get the proper retirement at retirement age, whatever that may be for you, and you have a home with equity in it, this will be another class. You could also do something called a reverse mortgage, which is way different from what it was 20 years ago. There's no gotchas. There's no way for your property to get taken and all those kind of things. It's really a good tool for individuals that are looking to maybe just eliminate a mortgage payment, because some people are still paying their mortgage payment into their 60s and 70s. If they could eliminate that $1,500, $2,000 payment and add that back into their budget, that's going to help out tremendously. Okay. Immediate variable annuity, the income is turned on immediately. However, variable means that the income will vary from month to month or year to year over the course of retirement according to the payment schedule. This payment is typically tied to something like a stock market, the S&P 500. It gets turned on immediately, but we know the income will vary or change depending on fluctuations in the market from month to month or year to year, based on how the funds are being dispersed. Deferred annuity or deferred variable annuity, same thing. It's income that's deferred and will be turned on at some point in the future. Typically, someone is planning for retirement down the road. The variable means the same thing as before. It'll vary from month to month or year to year when it's turned on, based on an index or a stock market or mutual fund or something that is tied to. Okay. It's going to fluctuate with the market. Okay. Now, there's a reason I don't do those annuities. I'm going to talk about the annuity that I do here in a minute. Here it is. It's the indexed annuity or fixed indexed annuity. It's actually a combination of the best parts of a fixed annuity and the best parts of a variable annuity. Funding an annuity is the same as funding other investments like stocks, bonds, mutual funds, etc. There's two ways to fund it. One is a lump sum. The second is a series of payments from month to month, year to year as you're preparing to get to retirement age. The second thing that you need to know is that the funds you put into the IA are tied to an index like S&P 500 without actually being in the market. So you have no chance of losing the money. You have all the potential of gains, no potential, for loss. And so I'm going to play a short video. It's 2 minutes, but it explains it a little bit more eloquently than I just did. Let me know if you can hear
Seems
this.
like retirement planning used to be a lot simpler. Your parents and grandparents generally worked for the same company for their entire careers, and then upon retiring were paid a pension, which continued to provide them an annual income every year of their retirement, no matter how long they lived. Simple, right? These days, pensions are all but extinct, as the burden of retirement planning has shifted from the employers to the employees. Now that they're responsible for their own retirements, many workers are looking for ways to recreate the annual income stream that traditional pensions provided without having to worry about running out of money in retirement. For those folks, annuities are an attractive option. Annuities are an investment vehicle that generally offers safety from loss while providing the ability to grow money, which you'll annuitize at retirement, basically turning what you've accumulated into a lifelong income stream that is guaranteed to last as long as you do. There are two types of annuities, variable and fixed. In variable annuities, your principal is invested in the market and can grow or shrink depending on what the market does. This is a riskier type of annuity, as you can lose principal if the market drops, but you do have the potential for higher upside if performance is good. In a fixed annuity, your interest rate is set and will not change despite what the market does. This is the most conservative type of annuity with the most predictable results. You're guaranteed to never lose any principal, but growth will be relatively modest. There is a special type of fixed annuity which offers the best of both worlds, the safety of a traditional fixed annuity and the upside potential of a variable annuity. A fixed index annuity, or FIA, will credit interest based on the performance of a market like a variable annuity, but establishes known as a ceiling and a floor to minimize risk. The floor is usually around 0% and will ensure that no principal is lost if the market goes down. In return for the safety of the floor, a ceiling would also be established that would limit the gains your money could be credited in any given period. Think of an indexed annuity as building your retirement skyscraper. When conditions are good, upward progress is made. There's no limit to how high you can build, only how much you can build in any given period. When conditions are bad, your construction may pause, but you won't lose any progress either. And when conditions improve, construction resumes. In a nutshell, the most important thing isn't how big a pile of money you can create before retirement, but the assurance of knowing that you'll never outlive that pile. That peace of mind is what annuities bring to the table that other retirement vehicles don't. Most insurance companies are required by their state's Department of Insurance to verify that the annuity you choose is suitable for your age, financial situation, and retirement goals. That being said, it is important to work with a financial advisor you trust. Not all annuities are created equal. Contact a trusted financial professional to get the specifics and see if an annuity makes sense for you and your retirement plan.
All right. Hopefully you guys got a better understanding of annuities through that short video.
Seems like retirement
Any questions so far?
You guys can raise your hand, or you can put information in the chat if you like. Terry, you have your hand up?
Yes. What if you have a fixed annuity and it's a deferred fixed annuity, and it was set for a number of years, and you take money out early? Are there substantial penalties for that?
So it all depends on what company you're with and their guidelines and regulations. How long ago did you start the annuity? I lost your.
Probably at least 6 years ago.
About 6 years ago.
Mm-hmm.
Yeah, we could take a look at it and analyze, what is needed in order to either continue or get out. Some of these annuities, as well as the next product that I have, they have what is called a surrender charge. They want you in for a certain length of time before you can move on. I don't want to ask your age or anything like that, because sometimes it's not, if you're getting close to the retirement age, it may not be worth it. But if you have time to make a move prior to retirement and still continue to go on and save, that could be an option. We just have to look at it.
Well, I'll give my age because I think I look good. I'll be 62 in September.
Oh, you're
so.
Yeah, I do this year too. Okay, so 62, and then when are you planning on retiring?
62.
Okay, so
Mainly because in my family, there's not people who live a long period of time.
Okay.
The oldest person is my mother, who's 88, and then I've had a sister and brother who died in their early 60s.
Okay. Well, what we could do is we could take a look at it and see if there's anything we could do, or if it's best for you to just hold with what you have.
Okay.
Okay. I'm going to kind of get into our next area here. It actually is another product, which is called an IUL, which we help. So one of the things we do is we are in LA Unified School Districts. We're up in Inland Empire. We're in all the school districts here in California. And we've been doing this since 2008, where we go in and we help teachers to meet the gap, because of course they have a pension, but in most cases their pension is going to take or meet about 50 to 55% of their income when they retire, and they're looking to, of course, like everybody, have 100% of their income when they retire. And so we go in and we talk to them about this next product, which is right here. First of all, most of you probably know this guy, Warren Buffett, or at least have heard of him. He's one of the wealthiest men in America. Well, Warren has a rule. Rule number one, never lose money. Can anybody guess what his second rule is?
Never lose money.
Oh, the first rule.
Never lose
Close.
money.
Who said that?
You mean never lose money?
Rule number two, never forget rule number one.
Oh, okay. Yeah.
And so that's the main rule, never lose money. And when I first saw that, of course, like I said, back in my FedEx days, I had lost money in my 401k, and I had to figure it out quickly how to be in position not to lose money. And after I learned, then I decided to teach others. Index universal life insurance. Now, most people, when they hear life insurance, they kind of cringe and run in the opposite direction. But universal life is a tool that can be strategically used to help build wealth for individuals. It was created in the early 80s, mainly for the wealthy. They used it as a combination of insurance and annuities, and it gives you a number of tax benefits. The best one is being able to build without any restrictions, but then also not losing money and being able to retire with money tax-free for the rest of your life. So the index product, again, it's a combination of fixed products and variable products. On the fixed side, for many, many years, you had an opportunity to have a steady fixed product, safety of principal and all those good things, but it paid out a very low rate of return. And then on the opposite side of the spectrum, you had the variable products, which gave you nice upside potential, but you risked your principal. You could lose all your money. And so people, like I said, in my case, and the people that I hang with, we don't like losing money. We like to grow the money, but we don't like losing money. Okay. And so here's a snapshot of the stock market. We call it the Wall Street roller coaster, the red line. And, you know, it has its ups and downs, just like the video that we shared on the annuities. The blue line is the indexed annuity. The main difference with this thing is it never loses money. So when your money goes up with the market, your money's not in the market, but it's indexed and tied to what the market is doing. It has a cap on it, which means the cap could be 10%, 12%, 14%. I've seen as high as 14%. So if the market does 20%, you're not getting 20%, you're getting 14%. But on the flip side of that, when the market does a negative 20%, your floor is zero. So you never go below zero. So you never lose any of your principal. It goes up. And then when the market is crashing, you hold steady. And then when the market picks back up, while everybody is picking back up from where they're landing, you are picking up from where you left off. And just in this simple strategy, with the safety and everything built in, without worrying about losing money or anything like that, over the 20-year period that we have this, and you might say, well, why is it up to 2017? I'll explain that in a minute. There's an extra $31,000 in there just by using that strategy versus putting the money in the market. The reason this isn't updated is every couple of years we update it. So 2018, this was updated. 2020, it was due to be updated, but guess what happened in 2020? We had COVID. And so COVID prevented a lot of things. In fact, we were not in the schools anymore. It was about 6 or 7 months before we figured out how to use Zoom and all that stuff, because we were old school. We didn't know how to do any of that stuff. We had to learn on the fly. So the next update is actually going to be at the end of this year, and it'll go from 20 years ago up until 2023. Okay. Seed or harvest. Most people have never heard this before. I heard it years ago about, if I were a farmer, just think about yourself. If you were a farmer and you had your seed and you're going out to plant your seed to grow this great harvest, and all of a sudden your favorite uncle shows up at your doorstep and he says, hey, I see you got some seed there. You're getting ready to grow a harvest there of whatever it is, corn, whatever. And he says, I can either tax you now on your seed, or I realize you've spent a lot of money on the seed. You're trying to get things going. You may not have the money right now. I can come back later. And so most of us, what we do is say, can you come back later? Well, when he comes back later, he's going to have a huge grin on his face, because at that time, now the harvest has blossomed. And instead of taxing you on that smaller version or that seed, now he gets to tax you on the entire harvest. That's what you're talking about when you're talking about the difference between an index universal life and a 401k. And it says it right here. You can see taxable deductible contributions, tax deferred growth, tax income, and it talks about the 403b because that's what teachers have, but the 403b is same as the 401k for non-teachers. This product that we talk about actually has a guaranteed lifetime income rider, just like the annuities. And so it gives an individual the opportunity to not only save in an environment where they can't lose, but they actually are growing their money. And when they have that harvest at the end for retirement, it's all tax-free. They don't have to worry about what taxes are doing, because we don't know what taxes are going to do in the future. We have so much money that this government owes. I mean, we're over 33 trillion or something like that for the deficit. We've had all these things that have come about from 2008 to the pandemic to this, that, and the other. If you were to go to, let's say, Vegas, which a lot of people do, and let's say you're going to, I don't know, I don't go a lot, but let's say you're going to play craps or whatever, and the dealer says, okay, listen, throw the dice, and whatever you land on, I'll tell you what I decide to do, if I'm going to pay you or not, or all the rules and instructions are hidden until you actually do the thing. And so that's what's happening today. A lot of people are retiring or saving in their 401k. They don't know how much they're going to have to pay in taxes. So you could save, $500,000, but what if the government says 50% in taxes or more, which there's been times in this country where taxes have been as high as in the 90%. And the government has to get that money from somewhere, so they're going to get it from us as, individuals that put money into 401ks. Okay, so there's a whole thing there. I don't want to give all of it because I'm going to play a short video for that too. A few years ago, Life magazine came out with an article in their magazine, and it was actually the headliner, and it said why it's time to retire the 401k. The 401k was created for the wealthy back in the day. Wasn't really created for everybody, but then it became something that everybody started to use once the pensions and everything like that started to disappear. But this plan is actually a better plan. If you can get your hands on that article, you definitely want to read that. The solution that we have is a solution that's one product that services multiple risks. Death benefit, if you should die too soon, the insurance portion is there for you. If you should live too long, which I never thought that as a thing, but sometimes people live too long. And what that means, if you run out of money and you live too long, that solution has been solved here. And then you also have what are called accelerated living benefits. Sometimes we live long and then we're hurt or sick or, chronic critical, these different illnesses is no fun if you can't take care of yourself. And so this one product takes care of all that. Gene's going to talk a little bit about those accelerated benefits here in a minute. I'm almost done. So what's the best strategy for you? It could be annuities. It could be life insurance. It could be a combination of both. We won't know until we sit down with you to kind of figure out what your actual goals are, what you're trying to do, what it is you want when you retire. Okay. And now here's another short video that kind of sums it up.
When it comes to retirement planning, there are three kinds of people. The guy who doesn't think about or plan for retirement, you don't want to be that guy. The gambler type who feels the only way to grow her money is to risk losing it all in the stock market, and the play it safe type who shudders at the thought of losing a single penny of his savings, even if it means sacrificing any opportunity for that money to grow. For years, retirement planning has been vastly limited to choices that fall on one side of the scale or the other. And so, money-savvy people tend to invest in 2, 3, 14, 50 different products in an attempt to balance the scale. But what if there was a way to capture the upside potential of a risky product and the downside protection of a secure product all in one solution? Well, hold on to your potatoes. Let's talk about IUL. Indexed Universal Life can harness the best parts of both sides of the financial seesaw. IUL is a form of permanent life insurance that, whoa, hang on. Life insurance has changed in the last 20 years. You know it as something that just pays out when you die. But these days, life insurance can actually be one of the most powerful wealth accumulating vehicles on the market. One huge benefit of IUL is the ability to harness the power of compound interest to potentially generate large amounts of non-taxable cash value within the policy. This cash value can be accessed later in life to fund a happy, healthy, non-taxable retirement. Your IUL's performance directly reflects the performance of the stock market index while implementing a 0% floor and a market cap, usually around 10%. So your cash value participates in the growth of the market up to the cap and sits safely on the sidelines when the market goes down. You forego some of the upside to alleviate all of the downside. So zero is your hero. With IUL, you won't spend a single day of your accrual making up for losses. Pretty cool, right? Well, it gets better. When designed properly, IUL can serve as a retirement vehicle based on a financial chassis of life insurance protection. And because of IRS tax code exemptions for life insurance, your cash value can create a tax-advantaged way to generate more income in retirement. That's something your 401k or IRA simply can't offer. So what might an IUL look like for you? Let's talk specifics. Larry here is in decent health, a non-smoker, and contributes $500 a month to his IUL starting at age 35. This contribution is conservatively projected to generate $500,000 of cash value by the time Larry retired at age 65. If he chooses to, Larry can turn on a non-taxable income stream from his IUL, giving him $60,000 of income per year to supplement his retirement. And the longer he waits to access this money, the larger it can grow. That death benefit is even accessible when Larry's still living if he suffers a critical, chronic, or terminal illness. So if Larry gets sick, he's covered. If he dies unexpectedly, his family is covered. And if neither of those things happen, the money Larry's paid into his IUL over the years can fund a happy, healthy, tax-advantaged retirement. Assuming Larry lives to age 90, he will have contributed a total of $186,000 into his IUL, drawn out $1.5 million in non-taxable retirement income, and still leave behind a very sizable tax-free death benefit for his heirs. The person who shared this video with you can show you what an IUL might look like for you given your specific age, health, contribution level, and retirement plans. Contact them today to get the specific numbers and see if IUL is a fit for you.
Pretty cool, huh?
Awesome.
All right. And
When it comes to retirement planning, there are three
Okay. There are also more great resources. These are the individuals that I took a look at to find out more about this. Ed Slott, he's probably the godfather when it comes to retirement tax-free. Ed Slott is a CPA and author. I'm not sure if he's retired from doing CPA work, but he's not. My point is, he's not an insurance salesman or an investment salesman or anything like that. His whole goal is to share with people how they can get to retirement safely and within a tax-free environment. There's also The Power of Zero, which I've read this book multiple times by David McKnight, and I'm actually going to be at a presentation that he's going to be doing actually in August. David McKnight talks about how to get tax-free income for life and The Power of Zero. And then there's also Doug Andrews, who does YouTube videos, and he talks about the same things. These guys are either CPAs, they're not in the business of selling these products. And so when I looked at these products, that's what I needed to find in my research, because a lot of the individuals that I was looking at before, they were either sponsored by certain companies that sold certain products, or they sold those certain products themselves. And so that's what they were pushing. These guys are, they're neutral, basically. They're not selling any other products, but they know what works. And so that's why I look to these guys. Okay, one last thing. It's another short video. I have four grandchildren, but I just recently, for the two babies, did $100 each for them, because the IUL also works for children. You can set up your children for the legacy that you didn't have when you were coming up, and it doesn't take a lot of money. Okay, it could be done for $25. It could be done for $50. So let me share this video, and then we'll be done.
A pretty money-savvy guy once said, "Someone is sitting in the shade today because someone planted a tree a long time ago." So you're ready to start saving for your kids' future. You already understand the power of compound interest over time, so you know the sooner you start, the better. So where should you be saving that money? Let's talk about perhaps the most powerful and least known savings vehicle for kids on the market, Indexed Universal Life, or IUL. IUL stands out against all other savings vehicles in one main area of strength: stability. Other financial vehicles lock you into what you can use your savings on, but an IUL can be a first car, a college education, a down payment on a house, a wedding. IUL cash value can be used however, whenever, and on whatever you choose. Plus, since it's built on a financial chassis of life insurance, your child is instantly covered with hundreds of thousands of dollars of permanent life insurance with living benefits, simply as a side benefit of utilizing IUL as your choice of savings vehicle. Now don't freak out, the fact that it's life insurance is actually a good thing. Life insurance cash value comes with a ton of unique side benefits, like your cash value being protected from market losses, cash value growing tax deferred and being accessible tax-free, protection from lawsuits, and IUL cash value is not considered in asset calculations when applying for student loans for college. So what could one of these policies look like for your kiddo? Let's say you had a baby today, and to take maximum advantage of the power of compound interest over time, you immediately start socking away $100 per month into an IUL. Right away, your child is now covered with $371,000 of permanent life insurance coverage with living benefits. That's a pretty nice little side benefit. And that financial foundation you establish for them today will continue to grow with them over the years and be available throughout their lifetime for whatever they need or want to use it for. Plus, if they don't access that money, right around retirement, their IUL is conservatively projected to hit $1 million of cash value. And at age 65, they could turn on a tax-free income stream of $75,000 per year that will last them the rest of their lives, no matter how long they live. The point is, they have options. IUL is the most flexible savings vehicle for children on the market, and the best time to plant that seed is today.
All right, that is
Awesome.
the end of my presentation. I'm going to let Jean take it over. Jean.
Thank you so much. Awesome presentation. Thank you so much, Anthony.
All right.
I won't have any questions right now that Anthony would be able to answer for you, or we can cover.
Pretty money savvy guy once said,
Uh-oh.
someone is
Sorry.
sitting.
That kid wants to keep going. Okay.
My mouse wasn't moving. I was trying to get to this next page because if
Okay.
anyone, we don't bother, or beg anybody to do business with us, but we are interested in educating people more and basically getting them to the point, or at least the information to get them to the point where they want to be, whether they use us or they have a family member or so on and so forth. So when you do that, when you set up an appointment with either Gene or myself, you will grab a complimentary summer vacation through one of the premier sponsors that we work with. And that could be anywhere. We have over 140 destinations. It's for the hotel only. Any transportation and or taxes will be paid by you. A lot of people use Vegas because it's close to California, or they use San Diego, Palm Springs. Those are the closest ones, but we have all the states and all other countries. In fact, I'm going to be using it next summer for Paris, France, to celebrate anniversary. So that is available to anyone wanting to sit down with either of us. Thank you for your time, and I appreciate it.
Good evening. Do you mind listing your information on the screen again, if you'd be so kind?
Sure.
And if you guys want to put your information in chat, be sure to do that. Thank you so much, Anthony. That was great information. I just wanted to, before we close out here, I just wanted you to just mention really quickly some of the deep benefits as far as the living benefits, how it kind of replaces long-term care.
Yeah. So this product, like I said, it has 3 areas, not only saving for retirement in case you live too long, or protecting your family if you pass early on, but it also has the living benefits we call the ABRs. And it is chronic, critical, and terminal illness. So if you have anything that happens, there's some stipulations, but we're probably the provider that we use is probably the best and quickest in terms of service. There's other companies that I heard that have really long waiting periods to activate those benefits. Ours are within a few days. So if an individual, let's say, is and we've had clients that have been diagnosed with cancer or something similar, to where if they didn't have the medical attention that they needed, which costs a lot of money, they were going to pass. We call this the insurance that you don't have to die. You don't have to die to benefit from. This lady, she was able to go in, request for part of her face amount. They gave her over $300,000 of her face amount. She was able to take a portion of that, pay for the treatment that she needed, and because of that, she's still living today. And so old insurance, you basically had to die to get and you didn't get the benefit, your family members got the benefit. Well, now with the new insurance that is sold today, if you don't have accelerated benefits, you're doing yourself a disservice. You want to have, even on our term policy, we have term policies with accelerated benefits, the IUL with accelerated benefits as well, where, you can make sure that if something happens to you outside of actually dying, one of our partners, he does his presentation and he always says, if you just barely die, they'll just barely pay you a check with the old type of insurance. They won't pay you. But with the new insurance and these benefits, you will actually be compensated from your policy. And in a lot of cases, it can help you to get past whatever health issues you're having, to live and continue on with your life. And so critical illness, chronic illness, and terminal illness.
Great. Thank you so much, Anthony. We do have 2 hands up. Terry, you had your hand up first, and then we'll go to Calvin. Thank you.
I had a question regarding an IUL for like a grandchild.
Mhm.
Are only the parents allowed to, or the parents or grandparents allowed to contribute to the IUL?
Yeah, I have two for my grandsons, and
Uh-huh.
I contribute to them.
Because
And
I was just thinking, I'll be a grandma pretty soon, and I was thinking, instead of getting a whole bunch of, like baby clothes and stuff like that, could
oh,
other people contribute to the IUL?
It has to be a relationship,
Okay.
and so yeah. When you say other people, are you meaning like other family members, strangers, or what have you?
Family and strangers.
Yeah, it's either the parents or grandparents or a legal guardian.
mhm.
Thank you.
You're welcome.
Thank you for your question, Terry. Calvin, you had your hand up.
Yes, for someone who's 62 or older, what would you recommend in terms of term, or is there an IUL product term, or
So
can you elaborate on that? Thanks.
yeah, IUL works really well if you're under the age of 50, because you still have time. I mean, even if you're 50 and you plan on doing it until 70, I mean, the numbers are not going to be great, but they're going to be better than nothing. Trying to start at 62, there are programs out there. There's a program called Kaizen, but it requires a lot of money. So if you're making, a couple of $100,000 a year and you can fast track yourself, yeah, you can do it. But for the traditional IUL at 60, most people don't have that type of money. And so they're not going to be able to meet the requirement. If they're looking to have some sort of insurance, just to give you an idea, I just renewed one of my term policies because I have a number of policies. And when I got the policy, I was 42 and it was for $1 million. And I paid $86.13 a month every month for the last 20 years. Okay, which was nothing. Well, when it came time to renew, which was just in February of this year, they said to continue with the $1 million, it was going to be not, because I'm going to be 62 in September. It's going to be $1,912 a month.
Woo.
Now, even if I have $1,912, I'm not doing that. So what I ended up doing, I just reduced that policy to $100,000 policy. It's still $100 a month, but the term is temporary. Yeah, and that's what it is in its name. It's for a certain term. So if you're 62, you can probably get 100,000. We have a number of, if your health is good and everything like that. I'm really in good shape, good health, and all that. So mine is $111 a month for 100,000 with one of the companies that we use called Protective. So yeah, that would be my recommendation to do term. But term nowadays, it also comes with the living benefits. So
Yes,
if you're
it does.
if you're looking to have the living benefits, and that's the option that you need to go through, then it's less expensive to do it that way.
Very good. Thank you so much, Anthony. Any other questions at this time? Really, if I don't see any other hands, there's no information in the chat, no questions. What I want to do at this point is just really thank you all for attending our meeting tonight. I hope you were able to write down, take notes of great information. Anthony's awesome. He knows the insurance inside and out, a great partner. And I really appreciate you tonight going over this information for us.
No problem
So
for you guys.
yeah, we really appreciate it. It's great information, and I think sometimes it's information that never gets enough recognition.
Nope.
Just as you said. So I'm really grateful for that. What I'd like to do is, I know we've had quite a few on tonight, some of them had to get off, but I'd like for you to really quick Elevator pitch, I just want you to give us your name and the business that you're in. And I am going to start with, let's see.
I'll volunteer.
Okay, Calvin, go right ahead.
Yes.
Really quick, you have less than an
I'm-
elevator pitch because our time is up, okay?
Yes, I represent Credit Card Savers, and our website is creditcardsavers.net. We have a program that would help someone in a position where they have $5,000 or more of credit card debt to eliminate that debt without bankruptcy or debt settlement company type of activity. And deals on our website. If you have questions, if you have some credit card debt, or if you have a situation where your business, you're relying on those credit lines, you don't want to lose those, take a look. Okay, thank you.
Thank you. Thank you so much, Calvin. Terry.
Hi, my name is Terry Larry. I'm a certified public accountant, and we are having a webinar Thursday at 6 o'clock on forms 1099s and on savings. So you can go to the Chamber of Commerce website and log in and register for that webinar. Thanks.
Great. Thank you so much, Terry. Tracy Williams.
Hello, everyone. I'm Tracy Williams, and I am the owner of T.D. Williams Land Use Consulting, and I specialize in building permit entitlements and zoning services relating to city planning within the city of Los Angeles, as well as the county of Los Angeles. So if you're interested in adding on to your home or you have zoning questions, please give me a call.
Thank you so much, Tracy. We appreciate you
welcome.
being with us tonight.
You're welcome.
Let's see here. Pauline is.
Pauline. Yes, I'm here.
Okay. Really quick, introduce yourself and give us the name of your business as
I
well.
am Pauline, known as the Wall Street Nurse. Can you hear me?
Yes, we can.
I'm
I
known
can.
as the Wall Street Nurse. I'm an educator. I educate individuals how to create passive income on Wall Street, how to create passive income of $10,000 a month that will generate $10,000 a month. I will go from generation to generation. This income is not likely to ever to stop coming in. But the most important thing, you have to be knowledgeable. The stock market is one of the greatest business on earth, but you have to be knowledgeable. And why it is so great? You're investing in other corporations. They do all the work for you.
Thank you. Thank you so much, Pauline. Thank you for joining us as well tonight. Let's see. Have I missed anyone? I'm going to have Dexter McLeod come on just for a second.
Good evening, great information. Thank you, Anthony, and thank you, Opa Jean, for bringing this wonderful information to our community and to our members. So thank you all very much. Dexter McLeod, LA South Chamber of Commerce, LA South Connections, our digital magazine and destination guide, as well as LA South Hope Foundation. Thank you.
Thank you very much, everyone. And we have those that are not on Zoom tonight. If you're listening from Facebook Live, we also appreciate you. Terry, you had a question? You're
No,
okay.
I did not. I was just commenting that this was a great Zoom call, and I learned a lot.
Terry,
Great, very good.
may I suggest something to you?
Uh-huh.
Okay,
What I
okay,
do?
Pauline,
Yeah.
we don't have a lot of time right now, so I'm just trying to get those people that were on the call.
Okay.
Like I said, if you have, you can talk in the chat, but we're about to leave. Our time is actually up. So I really want to thank everyone for being on tonight. I really thank you, Anthony LeBlanc Sr., for being my special guest. Great information. And this is something that we must do again because it is much needed. And then hopefully next time we can go into the details of long-term care a little bit more and that $1 million baby. Again, thank you. If you guys have any questions, you do have his number there as well. I'm also available to you. You have my information, and we look forward to hearing from you. Thank you again and have a great evening. Thank you, Anthony.
Thank you.
All right. Good night, everyone.
Good night.